Welcome to another deep dive. And this time, we're tackling the world of venture capital.
Yeah, from an investor's perspective.
Exactly.
We've got this investor letter that you shared with me from Allied Venture Partners.
Yeah, their 2024 annual report.
Right, penned by the firm's founder, this guy Matt Wilson, and he really digs into, the current market conditions and what he sees on the horizon.
It's a fascinating glimpse into what's happening both in the public markets and the private markets, and what he's actually planning to do with his own firm next year.
Exactly.
Okay, so where does he start?
Well, he kicks things off by kind of setting the stage, right?
Okay.
He's painting a picture of, the current market landscape, and it's kind of like a mixed bag.
Yeah, I was going to say, I've been reading a lot of conflicting things like, are we doing well?
Okay.
Or are we headed for a recession?
Exactly. So he calls it this tale of two cities, I think is the phrase he uses.
I like that.
So on one hand, you have the public markets, which have seen some really impressive returns this year. The S&P 500, for example, jumped by over 28% in 2024.
Wow, that's huge.
Hitting more than 50 new all-time highs.
What's fueling that kind of growth?
He attributes it mainly to central bank policies, and particularly the interest rate cuts that we saw earlier this year.
Right.
Which, when you combine that with a generally optimistic economic outlook, it's kind of fueled this rally we've seen.
Okay, so that makes sense for the U.S.
Yeah.
What about Canada?
Right. How did we do?
How did we do?
Well, Canada also had a strong year.
Okay, good.
The TSX Composite Index saw a gain of over 22%, also reaching a bunch of new record highs.
Wow. Okay, so sounds like a pretty good year for investors.
Overall, yeah.
Does Wilson think this is going to stick around?
That's where things get a little interesting, right?
Okay.
While he acknowledges, that public markets have done really well, he's actually predicting a more subdued 2025.
Okay, so like a little bit of slowdown.
Yeah, a little bit more cautious, a little more subdued.
Why? What makes him think that?
Well, he points to a few factors.
Okay.
The first one is, the new U.S. administration.
Oh, right, yeah.
Which is still kind of finding its footing,
Right.
And that always creates a bit of uncertainty in the markets.
Of course.
What are they going to do? How are things going to change?
Absolutely.
And then he also mentions potential economic headwinds in Canada specifically.
Like what?
Things like rising unemployment and the ongoing trade tensions, with the U.S. and China.
Right, so those global things are going to affect Canada as well.
Exactly. And those things definitely make investors a little more cautious.
Absolutely.
So we have this contrast, right? Like public markets doing great, but there's this sense of caution looking ahead to next year.
Yeah, like enjoy it while it lasts, maybe.
Yeah, potentially.
Okay, and I'm assuming this contrast, it's even more pronounced when you look at private markets.
Exactly, because that's where venture capital really lives, right?
That's it, yeah. So what's happening over there?
Well, while the public markets were, celebrating this big comeback, the venture capital world's been facing some pretty big challenges.
Yeah.
Especially when it comes to fundraising.
Yeah, we've been hearing a lot about that.
Right, it's a real capital crunch. Like, Wilson actually talks about founders and fund managers just struggling to access capital.
Wow.
Which is leading to, some interesting shifts in the whole ecosystem.
So how are startups actually adapting to this tighter funding environment?
Well, one of the biggest trends is this rise of bootstrapping.
Right, we've heard about that.
More and more founders are choosing to rely on, their own savings, their revenue, or just very limited external funding to get their businesses going.
So they're kind of like, forget the big VC checks. We'll do this on our own.
Yeah, for now at least.
Interesting.
And even when they do seek funding, the landscape has changed a lot.
Like how so?
Seed rounds, those are typically the first round of institutional funding a startup raises. They're generally much smaller now.
Okay.
Often under $2 million.
Wow. That's a big difference.
Yeah, it means the bar is higher. Founders need to show way more traction to even attract investors these days.
Like what kind of traction?
Think monthly recurring revenue of at least $10,000 to $25,000.
Wow.
And even then, the timeline from seed to Series A funding has stretched out to 24 months or more.
Okay, so it's a completely different game now than it was just a few years ago.
Totally different.
Wow, that's a lot for startups to deal with.
It is.
So if it's harder to get funding and the timeline to Series A is longer, that's got to be creating a lot of challenges.
Oh, absolutely. It's tough out there.
Yeah.
But Wilson actually argues that this challenging environment, it could actually be a good thing in the long run.
Really?
He sees it as this like refining fire for the venture capital world.
Oh, interesting.
These tougher conditions are forcing founders and investors to be like way more discerning, more focused.
So it's kind of weeding out the maybe not so good ideas and the people who aren't really committed?
Exactly. Only the truly strong companies are surviving.
Wow.
And that's why Wilson believes that right now is actually the most attractive time in the past 15 years to be an early stage tech investor.
That's a bold statement considering all the challenges we've just talked about.
Right.
So what makes him so optimistic?
Well, he outlines 3 key factors.
Let's hear them.
Okay, first, valuations are more reasonable.
Right. Things were getting a little crazy there for a while.
Totally. Those crazy valuations we saw back in 2021,
Yeah.
those days are over.
Gone.
Private market valuations are back to more reasonable levels, which means, investors can get in at a much better price.
Less hype, more focus on the fundamentals.
Exactly.
I like that.
All right, second factor.
Hit me.
The quality of the deal flow is higher.
Oh, interesting.
Because it's harder to get funding, the companies that are actually making it through are often like the cream of the crop.
Oh, so the tough fundraising environment is actually acting like a filter.
Yeah, a really good filter. It's making sure that only the strongest companies are getting funded.
So they're proving themselves before they even get to the VCs.
That's the idea. Wilson points out that, a lot of founders are now bootstrapping to like 6-figure revenue and showing really impressive, double-digit monthly growth before they even consider taking outside capital.
Okay, so investors are getting in at a later stage,
Yeah.
but with much less risk.
Yeah, they've already proven their concept. They've proven their ability to execute.
Okay, smart.
Okay, and then the third factor.
Yeah.
Increased operational efficiency.
Ooh, okay.
Startups are doing way more with less, and a big part of that is thanks to things like AI and other technologies.
Right, using the tools that are out there.
Exactly. Streamline operations, cut costs, the whole thing.
So it's not just about the product itself, but it's about how efficiently these companies can actually run.
You got it.
Okay, and this trend benefits everyone.
It helps founders reach product market fit faster, scale more efficiently, and for investors, it just means that their capital is being used better, more effectively.
Yeah, like getting more bang for your buck.
Precisely.
I like it.
And he actually gives a couple of cool examples from his portfolio.
Okay.
One company was growing, 2 to 3x year over year.
Pretty good.
Yeah, not bad. But then their growth skyrocketed to 4x in 2023 and a whopping 10x in 2024, all thanks to integrating AI into their processes.
Wow, that's amazing.
Right.
Yeah.
And then another portfolio company, they saw, get this, an 8-to-1 efficiency improvement in their customer service department after they adopted some new tech.
Oh, wow.
Think about that. One person doing the work of 8 people.
That's wild.
It's a game changer for a startup's bottom line.
Huge.
Huge.
So, okay, so even though the venture capital landscape is, going through some stuff right now, Wilson is saying it's actually creating this really strong foundation for future growth.
Yes, he really believes that the companies emerging from this period, they're going to be leaner, more efficient, more resilient, which ultimately benefits investors.
That's a really interesting way to look at it.
Right.
It makes you wonder what kind of companies will come out of this period of pressure.
Exactly. And that leads us to the next part of the letter, where Wilson starts talking about his plans for Allied Venture Partners and how he sees the firm evolving in this new landscape.
Okay, I'm really interested to hear about that. But before we do, let's just take a moment to recap what we've learned so far about the state of the markets.
Oh, yeah.
Okay. So we've seen that public markets are performing well, but there's that, sense of caution looking ahead to 2025.
Yeah.
Private markets are facing this capital crunch, but it's creating some unique opportunities for investors who are, willing to do their homework.
Absolutely.
And it's really interesting to see how these two markets are, kind of interacting and influencing each other.
Right. It's not as simple as just saying the market's up or the market's down.
Yeah.
Exactly. Much more nuanced than that.
Totally.
Okay, so with all of that in mind, let's hear about Matt Wilson's plans for Allied Venture Partners and how he's navigating this very complex landscape.
It is a very complex landscape, for sure.
It is.
So that's where Matt Wilson's strategy for Allied Venture Partners comes in.
Okay.
His whole goal with Allied is to kind of give access to capital for these startups in Western Canada, but also give investors a chance to get in on the ground floor
Okay.
with these high-growth companies.
Yeah.
It's ambitious, especially considering what's going on in the venture capital market right now.
It's definitely a challenge.
It is, but Wilson seems to have a plan.
Okay.
He refers to it as like a dual strategy,
Okay.
and he breaks down the development of Allied into these distinct phases.
Oh, okay. I like phases.
Yeah.
So what's phase one all about?
Phase one was all about building a global investor network.
Okay.
He achieved this by essentially syndicating promising venture scale opportunities like across North America.
So he was bringing together this community of investors who are, ready and willing to back these high growth companies.
So that's what he means by syndicate. It's
Exactly.
like a group of investors that kind of pool their resources together.
Yeah, it allows them to invest in startups that they might not have access to otherwise.
Right.
But it also allows Wilson to, spread the risk a little bit.
Right, and connect companies with more investors.
Exactly. More potential
So
investors.
that makes a lot of sense.
Yeah.
So he builds this network, and then what happens?
So then in 2022, he moves into phase two, which focused on integrating more Canadian companies into the portfolio.
Okay.
He wanted to put his money where his mouth is and really support the Canadian startup ecosystem.
Yeah, we got a lot of great companies here.
We do. And he acknowledges that, a significant portion of their deal flow still comes from the U.S.
Makes sense.
Yeah, bigger market.
Yeah.
But he's committed to adding, 1 to 2 Canadian companies to the portfolio every year.
And he mentions 2 new Canadian companies that are added this year, right?
Yeah, in the letter, he talks about one from Calgary and one from Halifax.
Oh, wow. Okay, that's great. Some geographic diversity there.
Exactly.
Okay, so phase 1, building the network. Phase 2, more Canadian companies.
Right.
What is phase 3?
All right, phase 3, this is where things get interesting.
Okay.
This is where he initially envisioned launching a $3.5 million seed fund.
Okay, so like taking Allied to that next level,
Yeah.
becoming a more, traditional VC firm.
Exactly. The seed fund would allow him to write those initial checks of, $75,000 with follow-on investments coming from the syndicate.
Right.
But then he made a bit of a surprising decision.
Okay, what
He
happened?
put the fund on hold.
What?
Yeah, he'd already raised over a third of the capital,
Wow.
but he decided to pause the whole fundraising process.
Why would he do that?
Well, he realized that if he went all in on raising this fund, he'd have to pause all the syndicate activities.
Right.
For like a year, maybe even longer.
Oh, wow.
And remember, he thinks this is a really good time to be investing,
Right.
especially with the lower valuations, the higher quality companies.
He doesn't want to miss out.
It doesn't want to miss out, yeah.
Okay.
So he's prioritizing deploying capital now through the syndicate model rather than getting bogged down in, the whole process of raising a traditional fund.
Right.
And he also emphasizes that the syndicate model, right now at least, is the most efficient and effective way for him to achieve, his 3 core objectives.
Which are?
Support great founders, deploy capital, and deliver strong returns for his investors.
Okay.
So it's like, why fix what isn't broken,
Right.
The syndicate model is working, so he's sticking with it for now.
Okay.
But he is clear about his long-term vision for Allied.
Okay.
It still involves becoming a more traditional VC with multiple funds.
Okay, but what does that look like, considering he's pausing the seed fund?
Yeah. It's a really interesting approach, yeah. So his long-term vision is still to build this series of early-stage venture funds.
Okay.
But they would work alongside his existing syndicate.
So it's almost like a hybrid model.
Yeah, exactly. Like he's combining that, agility and accessibility of a syndicate with the more traditional structure of a venture fund.
Interesting. And this would allow him to, provide more support to companies as they grow.
Exactly.
Participate in follow-on rounds,
Right.
potentially build like significant ownership in the top performers.
Exactly. That's the goal.
Okay, so leverage the strengths of both models makes sense.
Yeah.
But I notice in the letter he talks about keeping these future funds relatively small.
Yeah.
Why is that?
He's a big believer in staying really focused.
Okay.
He wants to stick to Allied's, sweet spot,
Which is?
early stage investments in very specific markets where they have a clear edge,
Oh, yeah.
differentiation. And he feels that larger funds, anything over 10 million, would dilute that focus.
It's spreading yourself too thin.
Exactly. And it makes it harder to achieve those, really big returns.
Master of none.
Master be master of one.
Right. And he believes that this approach, in the long run, will lead to better returns for investors, and it'll create a more sustainable model for Allied to grow.
Yeah. It's like he's playing the long game.
Yeah, totally.
He's playing to his strengths, thinking about the sustainability of the firm.
For sure.
So to recap, pausing the traditional seed fund for now. But long-term vision is to build these smaller, more focused venture funds
Yeah,
that work alongside his successful syndicate model.
exactly.
And he thinks this kind of hybrid approach will allow him to continue doing what he's doing.
Yeah, support great founders, deploy capital effectively, deliver those strong returns for his investors.
I mean, it's a very compelling vision, especially given, everything that's happening in the market right now.
Yeah, he's not shying away from the challenges, he's embracing them.
Yeah, he's like, bring it on.
Yeah, exactly. Finding creative ways to adapt.
It's inspiring.
It is. This has been a fascinating look into, the world of venture capital.
It has.
We've learned so much about, how the markets are working, the challenges and the opportunities for startups,
Right.
investors.
It's a complex world out there.
It is. But hopefully this gives our listener a better understanding of the landscape.
Yeah, what it really takes to succeed in this industry.
I think the biggest takeaway for me, and hopefully for our listener, is that even in a tough market, there are opportunities out there.
Yeah, you just got to be, willing to adapt, be resourceful, focus on those fundamentals.
Like Matt Wilson is doing.
Exactly. If his track record is anything to go by, those who embrace that mindset, they're going to be successful.
And that is a great note to end on.
It is.
So thank you so much for joining us on this deep dive.
It's been a pleasure.
And we'll see you next time.